So the root of mortgage is mortem, which means until death. So mortgage literally means loan until death. And in this video, I'm going to be showing you the difference between a repayment mortgage, an interest-only mortgage, and why you want to die with as much debt as possible. So if that interests you, carry on watching. But in the meantime, make sure to hit the subscribe button and the notification bell, and it will really help me if you could do me a favor and just lightly tap the like button, and we'll jump straight into the content. That might have been a little bit dramatic introducing it like that, but I did want to get your attention and hopefully gave you a chance to smash the like button and of course the subscribe and notification bell. So let's jump in. So first of all, why am I even talking about this? Well, it's really important to understand this from an investment perspective. So let's start by defining and showing you what repayment is and interest only is. So repayment obviously is paying down the mortgage over a period of time. So just as an example, if you have £100,000 loan and you are paying it over 25 years, then this is something what it's going to look like on a graph, okay? So if we've got money there and time here, so time over 25 years, and on this side we've got 100k all the way to 0 there, what's going to happen over this time period, if we just change the color, is it's going to dwindle down. But it's really important that you understand this curve, because most people think it's going to go like that, and it's not, okay? Some people think it's going to go like that, and it's not. The reality of it, and I'll explain why it happens this way, because it's going to help give you a deep understanding of why we do buy-to-lets the way we do, goes like this. And then it pays off quicker and quicker and quicker. And then the last year is pretty much just paying it off, okay? So the reason why, I'm not going to go into the financial metrics of this, but in the first 5 years especially, if we go here, say that's the 5-year route and then that's the 5-year route here, you can see that that mortgage, the last 5 years, is getting paid down really quickly. But why? Why is that? And why in the first 5 years does it barely go down at all? Well, it's to do with how a mortgage gets paid down. So what happens is, let's say you're paying 5% interest. You won't be, it's cheaper than that. But let's say it's 5%, but you pay £500 a month on a repayment mortgage. Well, 5% is £5,000 over a year. Still with me? £500 a month is £6,000 a year. So in that first year, by the end of the year, you have paid £5,000 in interest, and the other £1,000 is paying it down. So you've only paid down £1,000. So the next year, you still pay £6,000. Let me just break this down a little so we can get the numbers. Can we see it here? So year one, you pay £6,000 off. The interest, and then we'll go to the repayment, is £5,000. And £1,000 goes on the repayment. Make sense? So in the second year, we're still going to be paying £6,000, but now we've only got £99,000 as a loan right now. So 5% of 99,000 isn't going to be 5,000, but it's going to be pretty close. It's going to be £4,950. So year two, we've just paid off £1,050. Woohoo! Okay, so each year, that's only dropped by that, but each year that gets bigger and bigger. So let's just do another example of year three, just so you can see it's a bigger gap than £50. So year three, just as an example, you still pay £6,000, but now you're only paying interest on £97,950, which is £4,897.50. Okay, so the main point here, and then the remaining £1,102.50 is paying it off. So you see here that the first year you've paid an extra £50. The second year you've paid an extra £52.50. So it's small increases, but it does get bigger and bigger and bigger. And over the last, the last 5 years, it's pretty much all capital that you're paying off. So that's how you're paying down a repayment mortgage, and why in the first 5 years it feels like you're barely paying it down at all. So let's move on to interest-only mortgages. Moving on to interest-only, here's the difference, okay? So what happens over the same period is the loan is 100,000 and the time frame is 25 years. And then what happens is, as time goes on, you still owe £100,000. Okay, so the amount you owe doesn't ever go down. Now, why is this good? Why is it bad? Well, if we look at the actual interest rates, we're probably going to be around the 3% mark. You're actually getting it closer to 2 right now, but 3%. So what happens is, on an interest only, we're going to put IO there, you're going to pay £3,000 a year. Okay, now what's going to happen on a repayment, and this is probably more reasonable, you're probably going to be paying more like 5,000, something like that, okay, and you're paying it down. Now, we're going to break down why it's more important for buy-to-lets more than anything else, but what happens is, over that 100,000 or the 25 years, the 100,000 is not going to change, but you're paying a lot lower, and so on the buy-to-let you are cash flowing. But what the real plus is bringing in the interest through the rental and the capital uplift of the property. But the main thing for you to get as a fundamentals is, repayment is obviously paying it down. Interest only is not getting paid off at all. You're continuously paying it. So why does a bank do different things for different products? Well, let's have a quick look at residential. So residential property, you are going to live in this property, yay, you're happy, all of that sort of thing. Now what happens is, you are going to live in that property, and as you get older, older, let's say you're going to retire, currently 65, if we have anything to do with it, much earlier than that, but 65 years of age, you go out there and you're going to retire. Well, what happens then? You don't have as much money, you're living off a pension, most people. So the bank doesn't want to be owed money by you at that point, okay? It's why my mom, who's in her 50s and got a mortgage, can only get something like an 18-year mortgage, because they don't want her owing money when she's 70 odd years old, because the earnings aren't going to come in. And so what happens is, you've got that curve again where it's paid off and it's done. So the risk of that is really important, because the money and the flow of money becomes more risky the older you get for the bank. Make sense? Whereas a buy-to-let property, we're still going to have Dave in here, but he's renting this, isn't as reliant at all on your income. Okay, so the risk actually gets lower and lower and lower, because what happens, well, here's the little brief history. We're kind of this tiny island. That's the UK, obviously. We have around 70 million people living in the UK. We have 25 million houses, give or take. You can see the problem there, and England, we like to produce, right? So that figure is just going up and up and up. And we have what is known as green belt. So let me just change some colors on here because I'm an artist. We have all this green belt around the UK, which means you cannot build on it. Okay, so the only way now we have is, we still can develop. There's still a load of, I'm not going to go into the development zones, but we still have a lot of space to go up and develop, but it's getting harder and harder, hence the rise of houses of multiple occupancy and stuff like that, and skyscrapers getting taller, all of that sort of thing. So when supply is lower than the demand, i.e. the demand is insatiable, it's going up and up and up, what do you think of prices? Do you think they go up, or do you think they go down? Up, okay? So rents go up like this. Values of houses go like this. So the risk gets lower and lower. And remember, the mortgage company is relying on good old Dave here, who I think I've changed his name about 5 times in this video now. He identifies however he wants, right? And then, so what's happening here is Dave's paying the rent. And the rent is going to pay the mortgage, and it's going to pay you. Yay! So the difference between a property that you're going to live in and a repayment mortgage is, they need you to pay it off, because otherwise your risk increases. So they want you to lend the money. You're going to pay a rate on that they're happy with, which is really cheap. Mortgage money, really, it's the cheapest money you can pretty much get anywhere. But a buy-to-let property, they really want to go to the root of what a mortgage is, which is until death. Because you are not increasing the risk. If a tenant moves out, you get a new tenant in and then they're still getting paid. So if they could have a mortgage on this, a mortgage company would love to get this set up as a buy-to-let, get you to die, not sooner than you need to, but when you die, you hand it down to your kids, and then they want to give them the same mortgage until they die and hand it to their kids. And if they could have thousands of years of buy-to-let mortgage on this, they would absolutely love it. So why is it so important for you, and what's the benefit of doing it? And actually repayment is a blip in the ocean for you as a buy-to-let landlord. Well, it all is all down to capital growth. So it was Einstein that said the eighth wonder of the world is compound interest, but you really don't understand the power of that until you go down. So will it double every 10 years forever? I don't know. Okay, the past doesn't dictate the future, but I do know they're going to continue to go up, but it won't be like that. It will be like especially right now with where the economy is going, okay? But in general, you can pretty much guarantee property prices do go up and up and up. So let's look over a 30-year period, okay? 0, 10, 20, and 30. Let's say we're starting at 100,000. Now this is where the growth really happens. If we go 200,000, 300,000, 400,000, and 500,000, and then we'll write more if we get to that, okay? So on a 100k mortgage, the repayment, obviously you've got that curve that you're going down, and on interest only it's a straight line, okay? But here's why mortgage companies don't care about the risk, and why you need to focus on the cash flow coming in, because ultimately that is going to be your retirement plan. And if over time you want to pay down the equity to make sure that your risk is lowered, that's absolutely fine. My ultimate goal is to have 1,000 properties at 50% equity and 50% debt, just so I've got a really strong, solid portfolio that is risk-free, so I can focus on giving back and doing what I love, which, if you know anything about me, is more about the charity stuff that I'm trying to focus on now, and building the teams and educating others. So here's what happens. If you've got 100 property, let's just take it doubling every 10 years as a fact. It's not quite a fact. It doesn't double every 10 years. There are periods that go like that, but over the length of time, a period of time, historically it is that, okay? So here's what happens. On a £100,000 property, you are going to have a £70,000 mortgage. Now, if you remember and go back to the video where I was talking about that curve and how little the actual mortgage is paid down in the first 5 years, this is going to be really important for you to think of that in your mind as I go through this. First 10 years, it doubles in value. 100 times 2, 200,000. So we're going there, right? Then what happens is it's going to double in value again. So it's not adding 100,000, it's doubling in value. So in the next 10 years, from 10 to 20, it goes to 40,000. So again, now the curve is higher. Then what's going to happen is it's going to go here. I don't know why I'm going there. I have the ability to lower this. So let's bring that down a little, okay? So that 500, again, I want this to be realistic. Can you still see here? Yeah. So I want this to be as realistic. So 300, 400, 600, 700, and then 800 there. Because I kind of want to just see a visual of this growth. It's then going to go to 4 to 800. So again, look at that line. Okay, I mean, that got awful, didn't it? But if we look at that line, let me just rub that off because I want that to be a bit neater. If we look at that line, how it goes up, now it might be in your head, it's like, that's absolutely ridiculous. But that is what it looks like. That is the growth of property, where you have this upward trajectory that accelerates over time. Now, here's why it's important. If you're looking to grow a portfolio, you are going to be implementing a buy, refurbish, refinance video. And I've done videos on how to add value, check it out. Buy, refurbish, refinance, check it out. And one of the most popular videos on this channel, buy to let basics. Check out those 3 videos and it'll give you a really good deep dive overall information on why this is so important. So you're looking to refurbish finance, i.e. utilize the value of the property. Okay, now when you're in an aggressive growth model, you want to keep your debt to equity ratio at about 75% loan to value, i.e. 75% debt, 25% equity, and then you build that up over time. So here's what's going to happen. If this is true, let's say you are refinancing every 10 years. Now, on a repayment mortgage, you're paying down over the first 10 years, maybe 15 grand. That sounds like a lot of money, but if in 10 years it's gone up in value, £100,000, do you really care about 15 grand? Had barely any cash flow because of it, because it's really impacting your monthly money? Or do you really want to focus on the cash flow so you can have a supplemental income to, help along with the job? Because, especially right now with all the risks with job security, maybe you want to live off your portfolio one day. Maybe you want financial freedom. That is what it's about for me. Buy-to-let number one is the cash flow. Capital growth is just a benefit. So here's what happens in 10 years. I'll draw this up here so you've got it. I'll change the color so it stands out a little bit more. So 10 years from now, we refinance at 200,000, and let's say you are aggressively building this portfolio, 75% loan to value. So what's going to happen is you are going to get 150,000 back off of it, 50 grand left in. So now you've got 50,000 in, you've got 150 grand, but remember you got a 75 grand mortgage on it originally. So you have to pay that other mortgage off with that money, and you've got a new mortgage of 150,000. So you've now got £75,000 cash in your pocket. You've also got a property that's now got 50 grand equity, which isn't the same as cash, but on paper, your net worth is still 50 grand higher, and your rents have gone up in line with inflation and above almost all the time. It's an RPI. More on that later, it gets a bit complex. But your rent's gone up, the values have gone up, so your mortgage interest is still getting paid, more than paid, and your profits have increased from your rent, and you've got cash in here. So the benefit to the lender, the mortgage company, is if you've done the numbers right and they've done their numbers right and you've bought a good buy-to-let property, they are always going to get paid, which is what they want to do. You are getting somebody else paying you money to live in a property that is paying out £75,000 in the next 10 years, plus your rental income is absolutely insane. Okay, now if that doesn't explain the benefit of why you want to do interest only over repayment, I don't know what will. So you are going to get a load of people saying, yeah, but I still prefer to pay it down, and that's absolutely fine. This is just one man's opinion that I'm sharing with you. Okay, so I get really excited about this. You can probably tell I'm getting told to be quiet because I'm getting too excited. So watch this again, really let this sink in, understand it. If you choose to do repayment, that's down to you, no problem. But I'm doing interest only. I'm building my portfolio. I'm excited about it. I'm aggressive on it. So I am getting to that 25% equity, 75% loan to value, looking at it, doing portfolio reviews as I build and refinancing. And once you've got 10, 15, 20 properties, which is hard, but you're constantly just being able to develop and refinance and build that portfolio, and your growth just accelerates on there. So I'd rather have the cash flow in my pocket and be able to utilize the money today, because the value of the money today is going to be more than tomorrow. I'm able to refinance every 5, 10 years and get those in. I'll usually do them every couple of years because of the growth. To get that money in, I think you should be doing the same too. Watch this along with the buy-to-let basics video, how to add value to the property, and then the BRR, buy, refurbish, refinance. And if you watch those, you will have all of the foundations you need to start going out there using your own cash and other people's money, remembering your network is your net worth, and build your property portfolio. So, hope you've enjoyed that video. Make sure to hit the subscribe button, the notification bell if you're new to the channel. I'd really appreciate it. And if you can just do me a favor and lightly tap the like button, really does help the YouTube algorithm and pushes this out there to help more people. And of course, I'll see you in the next video.